Now that we've looked at everything to do with accounts receivable, of course, we are going to have some more ratios to look at. They're important for users, so we're going to take a look at these and how they're used. So we're going to be looking or evaluating the liquidity of receivables. And a reminder that liquidity is measured, or it's a measure of how quickly assets can be converted to cash. So for accounts receivable, obviously a business wants to be able to convert those to cash or collect them as quickly as possible. So cash is important. It allows you to buy other things, expand your business. So the quicker you can get that, the better. So businesses, they record their AR, but they also need to monitor this and figure out how quickly they're collecting and compare that as time goes on, so year over year. Now, you can't necessarily just look at accounts receivable on the balance sheet and say, well, it went up or down, and say, well, that's good or that's bad. So accounts receivable has a relationship with sales, or specifically with credit sales, because when we sell on account, that is how amounts go into accounts receivable. So if sales go up, we would also expect accounts receivable to go up because now there's more of those sales that are on account. Same thing, if sales go down, you'd expect accounts receivable to go down. But even with that relationship, it's still hard to compare just the values on the financial statements and look at the two of them side by side and know if they're changing at the same rates or if there's something else going on within accounts receivable that's important. And that's the reason why these amounts are changing. Therefore, we have these ratios that we're able to use to assess the liquidity of accounts receivable and determine how quickly we're collecting those amounts and if it's improving or worsening from years as they go on. So two ratios. The first is called accounts receivable turnover, or maybe just receivable turnover. And then the second is the average collection period. And this is really commonly also referred to as days in receivable. So our textbook calls it account or average collection period, but you'll likely see days in receivable if you go on and do accounting later. Okay, so we'll look at receivables turnover first. And these are similar to inventory turnover that we've looked at, only now we're using accounts receivable and assessing that. So this ratio is calculating the number of times on average that receivables are collected or turned over during the year. And the way that we calculate this, or the formula, is equal to credit sales divided by average gross AR. Gross AR, that's not what's meant here, but gross accounts receivable is what's actually in the accounts receivable account, so that total amount before we've subtracted the AFTA. So when we talk about gross and net, gross is the full amount, the net is after something's been deducted. So we will use accounts receivable in the accounts receivable account before any AFTA or that allowance has been subtracted. And we use credit sales here because only sales that are on account, which is called these credit sales, those are the only ones that create an AR balance. If it's a cash sale, we don't have accounts receivable. So if you have the information, you would use credit sales, but these aren't typically reported on financial statements. So if you don't know the credit sales, or if they're not given to you in a question, just use overall sales. And average gross AR, just like with inventory, when we're calculating the average, we take the opening plus the ending, and we divide that by 2. So that's how you'll get the average. Okay, so now if we know that this ratio is calculating the number of times that receivables are collected during the year, what is better, higher or lower? Right, higher is better. You obviously want to collect these or turn your accounts receivable over as many times as you can in the year. So higher is better, and it means that it's more liquid. So you're converting it into cash more quickly. Now, accounts receivable, we're going to get how many times we turn this over in the year. Again, this one, like I said, with inventory turnover, it's good, but it makes more sense when we look at it in the number of days. So we use this receivables turnover and we use it to figure out the average collection period or the number of days in receivables. And this to me makes far more sense and is an easier number to be able to evaluate. So the average collection period is the average amount of time in days that the receivable is outstanding. So basically how long from when you do the work and you give the invoice to the customer until you collect that AR. So how many days is it sitting there waiting to be collected? This is calculated as 365 days, and we divide it by accounts receivable turnover. So the ratio that we calculated on the previous slide. So now we're saying how many days does it take us to collect this accounts receivable? So what's better here, lower or higher? Right, in this case, lower is better because you want to collect it or have it sitting in AR for the less amount of time possible. So lower is better. And when you assess this, it's much easier in my mind to assess the days in receivable. And you compare this to your credit policy or to a business's credit policy. So when a business decides that they're going to sell on account, they would have a credit policy that says how many days that an invoice is due in. So 30 days is quite common. Sometimes it's 60. It depends on the business. But we compare the average collection period to this credit policy, and then it's easy for us to evaluate whether they're collecting in the good time frame. So if their credit policy says invoices are due in 30 days and their average collection period is 45, well, that's not good. They're not collecting as quickly as their policy says. So people are paying late. It's something we would need to look at. So that's how this ratio would be used within the business. They would compare it to their policy and know, are customers paying too slowly? If so, why is that going on and what should we do to make that better? Okay, so we can look at an example here. Coffee Corp reported the following selected information for, well, this should be the 3 years ended 2019, 18, and 17. We've got gross AR, the allowance for doubtful accounts, and sales. So first we need to calculate Coffee Corp's receivable turnover and their average collection period for both 2019 and 2018. And then ask the question, did the ratios improve or worsen in that time? Okay, so the reason we're given 2017, but we're only calculating these ratios for 2019 and 18 is because we use average accounts receivable. So we need to know this third year so that we can calculate the average for 2018. Okay, so if we start with part A, we can look here at our AR turnover and then our average collection. So we know that AR turnover is equal to our credit sales divided by average gross AR. And we want to use credit sales, but we're not given it in this case, so we'll just use overall sales. And then for our average AR, we will look at these two numbers, 2019 and 2018, to calculate the average. So we'll cross out credit. We don't have that, so we're just using sales. For 2019, we had $50,444 as our sales. And for average AR, the opening, so our 2019 was $1,865. Or sorry, I should say that was 2019. 2018 is our ending inventory in this year. That's $1,965. And then we need to divide that by 2. So if we do that math, we end up with 26.3, and this is times. So on average, we're turning over or collecting our accounts receivable 26.3 times in 2019. Okay, now we can do the same thing for 2018. Whoops, wrong way. So here we're using sales from 2018, and to calculate our average AR, we're using the 2018 and 2017 numbers. And we're just totally ignoring the AFTA in this case, because we know we use gross receivables, not net. So this is just extra information given you to make sure you know what information you actually need. And we need the gross AR. So for 2018, sales were $45,633. We divide that by our average. So our our ending amount in 2018 was $1,965, plus our opening, so that's the 2017 amount, was $1,686, and then we divide that by 2, which ends up with $45,633, and our average is $1,825.50. When we do that math, we get 24.997534, which rounds to 25.0 times. So in 2018, we turned our accounts receivable or collected it on average 25 times during the year. So part B says which is better, or has it worsened or has it improved? So for accounts receivable turnover, do we want a higher value or lower? Right, we want higher. We want to collect it as many times as possible, and therefore this has improved from 2018 to 2019 because it went up. So we can say that it improved. Now, as I said, even to me, these numbers don't mean a whole lot, and that's why I like the AR collection or the days in AR, because it makes more sense to me. So we can calculate the ratios here, and it's equal to 365 divided by our AR turnover. So in 2019, we take 365, divide by the 26.3 that we calculated, and this is days because that's what we're calculating. When we do this, we get 13.9 days. And that's something I can think about, and it makes sense. They're collecting their accounts receivable on average in 13.9 days. For 2018, we take 365 divided by the 25.0, and we get 14.6 days. So these are clearly related because we're using turnover in our ratio. So if one improves, the other one should improve. And we do see that here as well because we want a lower number of days that it sits in AR, and we have that in 2019. So this has improved as well, which would always be the case unless you calculated something wrong in your second ratio. Okay, so we know that Coffee Corp has improved their ratios, but we need to assess whether it's good or not to compare it to a credit policy. So this isn't in the question, but let's just say that their credit policy says that customers have 30 days to pay from the invoice date. If that's the case, is this a strong ratio for that company? Yes, because if the customers have 30 days, but Coffee Corp is able to collect in 13.9 or 14.6 days, they're collecting even faster than they're requiring their customers to pay. So that's great. They're converting their AR to cash really quickly and faster than their policy says. But now let's think or say that their credit policy actually says that customers have 10 days from their invoice date to make a payment. Well, now we look at this and the average collection is more than the 10-day policy. So that's not good. It's not that much more, but still it's more. Customers are paying more slowly than they're allowed to. So Coffee Corp would want to look at that and figure out why customers are paying slowly. Is there a way to get them to pay more quickly? Or maybe they shouldn't be granting credit if these customers aren't able to pay on time. Okay, so that is just a way to look at these ratios and use them to help make important business decisions.